In a global economy still navigating the aftershocks of pandemic-era disruptions, inflationary pressure, and the rise of economic nationalism, the automotive sector is once again under fire, this time from a 25% tariff imposed by the Trump administration on imported cars and parts, with Japan squarely in the crosshairs. At first glance, this might seem like just another salvo in a broader trade dispute. But beneath the surface lies a complex, deeply integrated industrial system spanning continents. Japanese automakers, including giants like Toyota, Honda, and Nissan, have spent decades embedding themselves within the U.S. manufacturing ecosystem, building over 3.3 million vehicles annually on American soil, investing more than $60 billion, and supporting some 2.3 million local jobs. The scale is vast, the stakes even higher. What we are witnessing is not simply a disagreement over tariffs. This is a test of the structural resilience of trans-Pacific supply chains, a challenge to 40 years of trade architecture, and a gamble that could either reset or rupture one of the most critical bilateral economic relationships in the world. Japan, the world's fourth largest economy by nominal GDP, has built much of its modern industrial power on the back of its export machine. Nowhere is this more evident than in its automotive sector. With a highly efficient and globally competitive supply chain, Japan has become a cornerstone of the international car market. In 2024 alone, automobiles and auto parts made up approximately 28% of Japan's 21 trillion yen, or roughly $145 billion, in total exports to the United States. This concentration of economic exposure makes the auto industry not just an economic pillar, but a geopolitical lever, and a vulnerability. The Japanese economy has long relied on large trade surpluses to maintain currency stability, fund domestic investments, and offset demographic pressures. But with U.S. tariffs now hitting the country's most strategically important sector, the foundations of that model are under stress. The country's export relationship with the U.S. is not only deep, it is structurally critical. Japan consistently ranks as one of America's top 5 trading partners, and in 2024 it was the 4th largest overall. However, the trade balance between the two nations is markedly uneven. The U.S. Trade Representative reported a $68.5 billion trade deficit with Japan, and more than 80% of that deficit was directly linked to automobiles and their components. This imbalance has become a political flashpoint. Citing national security and economic sovereignty, the Trump administration implemented sweeping tariffs in April, raising duties on imported vehicles from 2.5% to an extraordinary 27.5%. This sudden and aggressive change was framed domestically as a corrective measure, an attempt to reverse decades of perceived one-sided trade deals and revive domestic manufacturing. But for Japan, these tariffs represented a direct assault on its industrial lifeblood. Tokyo's leadership swiftly moved to contain the fallout, dispatching trade negotiators to Washington in an effort to seek exemptions and de-escalate the economic standoff. Time, however, is not on Japan's side. The White House has instituted what it calls reciprocal tariffs, and unless a bilateral trade agreement is secured by July 9th, Japan faces the imposition of an additional 24% across-the-board tariff on its exports to the U.S. Unlike the sector-specific 25% levy already in effect on automobiles and parts, this new tariff would broaden the impact, potentially hitting consumer electronics, precision equipment, and other key export categories. The pressure is compounded by the fact that Japanese companies had already front-loaded shipments in the months leading up to the tariffs, creating a distorted export baseline and adding complexity to any economic forecasting. What makes this moment particularly precarious is the scale of industrial interdependence between the two countries. Japanese automakers have not simply exported cars into the American market, they've built an entire infrastructure within it. With over 3.3 million vehicles produced in the United States annually, Japan's car companies operate dozens of manufacturing plants across states like Ohio, Kentucky, Mississippi, and Indiana. These facilities aren't just symbolic. They're logistical hubs, R&D centers, and employment engines, forming a deep industrial ecosystem that integrates U.S. suppliers, engineers, and distribution networks. Many of these plants also export vehicles to third-party countries, helping the U.S. balance its own trade books in key markets. Despite this complex entanglement, the tariffs are moving forward with full force, introducing volatility not just into bilateral relations, but into the broader calculus of global trade. The threat is not only economic but strategic. Tokyo's inability to secure a trade agreement thus far, despite repeated rounds of negotiations and high-level meetings, has cast doubt on the stability of the U.S. Japan alliance. just as the region grapples with rising geopolitical tensions in East Asia. As the July 9th deadline looms, what's at stake is far more than the price of a sedan. It's the future of trans-Pacific economic integration and the ability of two allies to reconcile nationalist economic agendas with the imperatives of mutual interdependence. The imposition of sweeping tariffs by the Trump administration marks a pivotal moment in U.S. Japan economic relations, particularly for the automotive and manufacturing sectors. The most consequential measure is a 25% tariff on foreign-made automobiles and parts, an extraordinary escalation from the long-standing 2.5% baseline that governed car imports into the United States for decades. This tariff was justified by the U.S. on national security grounds, a designation that Tokyo strongly disputes, citing the depth of industrial cooperation and alignment between the two allies. In parallel, the administration has implemented a 50% duty on imported steel and aluminum, raising serious concerns for Japanese component suppliers who operate under integrated production networks reliant on U.S.-bound raw material exports. Compounding the pressure is a looming 24% across-the-board reciprocal tariff scheduled to take effect if a bilateral trade deal is not finalized by July 9th, effectively a second front in an escalating trade conflict. For Japan, the stakes could not be higher. The government has responded with a combination of hard data and diplomatic engagement, arguing that the punitive tariffs are misaligned with the realities of contemporary trade flows. Japanese negotiators, led by Ryosei Akazawa, have emphasized that Japanese automakers are not merely exporters flooding the U.S. market, they are also significant domestic producers within the United States itself. Companies like Toyota, Honda, and Nissan manufacture approximately 3.3 million vehicles per year on American soil, more than twice the 1.37 million units they export directly from Japan. These local operations span multiple states and are deeply embedded in regional economies, particularly in the Midwest and the South. Moreover, Japan points to the broader economic contributions of these firms. Over the last few decades, Japanese automakers have invested more than $60 billion in U.S.-based facilities, supply chains, R&D centers, and dealer networks. These investments are not simply accounting entries. They represent a tangible industrial footprint that supports an estimated 2.3 million American jobs across assembly plants, logistics networks, and parts suppliers. Tokyo's position is clear. These are not predatory trade practices. They are deeply collaborative, mutually beneficial industrial relationships that serve both economies. The tariffs, in their view, risk unraveling this shared prosperity under the pretext of deficit correction. Despite these arguments, diplomacy has faltered. 7 rounds of ministerial-level negotiations between Tokyo and Washington have so far failed to yield a breakthrough. Each round has ended with reaffirmations of respective positions, but no substantive progress on the core issue of auto tariffs. The stalemate was publicly underscored during the recent Group of 7 summit in Canada, where Japanese Prime Minister Shigeru Ishiba and President Donald Trump were unable to reach even a preliminary agreement on tariff exemptions or phase-ins. Instead, what followed was a public entrenchment of both sides, Tokyo insisting on structural exemptions tied to its industrial contributions, Washington holding firm on its leverage through deficit-linked punitive measures. The collapse of diplomatic momentum was further signaled by Japan's abrupt cancellation of the planned 2+2 security talks scheduled for July 1st in Washington, which would have brought together the country's foreign and defense ministers. While the formal reason was not disclosed, several sources close to the negotiations revealed that the cancellation was triggered by an American request that Japan sharply increase its defense spending to 3.5% of GDP, a level not seen in post-war Japan and considered politically untenable ahead of national elections. The timing and framing of that request were seen in Tokyo as an attempt to use security cooperation as a bargaining chip in what had until then been framed as a trade and economic negotiation. This convergence of trade and defense disputes illustrates the complexity of modern alliance management in an era of transactional diplomacy. For Japan, which has long relied on the United States not only as a trade partner but also as a security guarantor, the intertwining of economic coercion with defense expectations raises profound questions about the future of the bilateral relationship. With the July 9th tariff deadline approaching and political calendars tightening in both countries, the prospect of a near-term resolution appears dim. What remains is a high-stakes standoff, one in which national pride, industrial policy, and geopolitical strategy collide and where every passing day without a resolution increases the economic cost for both sides. The economic consequences of the U.S. tariffs on Japanese automobile exports are no longer theoretical. They are now visible in hard data. In May, Japan's total exports declined by 1.7% year over year to 8.1 trillion yen, marking the first drop in 8 months. While the headline decline was smaller than the 3.8% contraction anticipated by economists, the underlying numbers reveal a more troubling reality for Japan's industrial engine. The most severe contraction occurred in exports to the United States, which plummeted by 11.1% compared to the previous year. This drop was led by a staggering 24.7% fall in the value of automobile exports and a 19% drop in auto parts shipments. What's critical to understand is that the sharp fall in value masks a less severe decline in volume. U.S.-bound automobile exports dropped only 3.9% in unit terms, suggesting that Japanese automakers are not cutting shipments, but rather absorbing the financial impact of the tariffs themselves, shielding American consumers from price shocks, at least for now. This price absorption strategy, however, carries its own cost. For corporations like Toyota and Honda, the financial pressure is mounting rapidly. Toyota, the world's largest car maker by sales, estimates that the tariffs shaved 180 billion yen off its profits in just 2 months, April and May. Honda has issued guidance warning of a 650 billion yen hit to its annual earnings from tariffs imposed not just by the US, but also by other key markets responding in kind. These losses are not evenly distributed across the sector. While most Japanese automakers have held off on raising U.S. prices to maintain market share and avoid alienating consumers, Subaru and Mitsubishi have already adjusted pricing, passing on part of the tariff burden. That said, this has been the exception, not the rule. The reluctance to adjust sticker prices may temporarily preserve demand, but it comes at the expense of corporate resilience. The Tokyo Stock Exchange has already registered investor anxiety. Automotive and transport companies have become the second worst performing group among the TSE's 33 sectoral indices, down nearly 12% for the year. The only group faring worse has been the precision equipment makers, who also face export pressures. This market decline reflects more than just headline sensitivity. It signals a reassessment of future cash flows, capital expenditures, and return on investment metrics across the sector. Beyond financial statements and earnings guidance, the tariffs are exerting more insidious pressure on the structural fabric of the Japanese auto industry. One immediate casualty is research and development. Automakers that once earmarked billions for electric vehicle innovation, autonomous systems, and hydrogen power are now redirecting funds toward operational liquidity and tariff-related risk management. The pivot away from R&D not only hampers long-term competitiveness, but may also allow rivals, particularly in South Korea, Germany, and even China, to accelerate their technological lead in strategic areas of the automotive transition. This reallocation of capital is also rippling across Japan's bond markets. Companies with high exposure to U.S. sales are now being reassessed by credit analysts and institutional investors who fear diminished profitability, reduced debt coverage ratios, and growing exposure to geopolitical risk. Spreads on auto sector corporate bonds have widened in recent weeks, and some Japanese manufacturers have already shelved planned issuances or refinancings amid elevated yield requirements. The knock-on effect of these developments is a more constrained environment for funding, not only for the automakers themselves, but also for their upstream suppliers and downstream logistics providers. In the consumer finance sector, the delay in price increases may initially seem like a win for U.S. car buyers, but it carries latent risk. Japanese automakers operating in the U.S. often rely heavily on lease financing to maintain competitive monthly payments. As tariffs continue to erode margin, the viability of 0% and low-interest lease promotions becomes questionable. This could lead to a tightening of consumer credit availability or higher financing costs, both of which would begin to register in monthly payments by the fourth quarter of this year. Should that happen, consumer demand may begin to soften, particularly in the subprime and mid-market segments, precisely the demographic that Japanese automakers have traditionally served with reliable, affordable models. What is unfolding is not a short-term price adjustment or a tactical shift in market strategy. It is a multi-dimensional rebalancing of cost structures, industrial planning, and financial exposure for one of Japan's most globally integrated sectors. The longer these tariffs remain in place, the more deeply they will reshape investment priorities, capital markets, and even the technological trajectory of the industry. For both Japan and the United States, the costs may ultimately extend far beyond fiscal ledgers, affecting employment, innovation, and the balance of industrial power in the decade ahead.